Friends, welcome to the first of a 5-part lecture sequence on corporate strategy. By the time you get to the end of the 5-part lecture, you should be ready to analyze corporate diversification, which is the topic of this lecture. Second is vertical integration. Third is international. The fourth is the mode of entry. And the fifth one is on how to evaluate strategy. So when you're done with that, you should be able to read the BRL Hardy case and do an analysis of their Distinto product launch and evaluate that strategy. Right? So that's a narrow focus of that. That'll help you get done with your second individual project for this class. But more generally, you should be much more skilled at analyzing and evaluating corporate strategies. So let's start out by very briefly pointing out the difference between a business strategy and a corporate level strategy, business level strategy and a corporate level strategy. It really has to do with the focus. So a business level strategy is about figuring out how to compete in a single discrete market. And so the question there becomes, what's my strategic position going to be in this market? Is it a cost, a differentiation, focus? And the corporate level strategy extends this to multiple markets. So the question we are asking there is, what business should we be in? Should we enter new product markets, which is diversification? Should we make or buy, vertical integration? Should we enter into new geographic markets, international? And supplemented, so those are the three broad corporate level strategies. Mode of entry has to do with, so how do you get there? You've decided to enter a new market. How do you go about entering it? Do you do it internally? Do you make a merger? Or do you do an alliance? Okay, so why corporate strategy? What's the rationale? And well, usually there's a bad rationale for this. A lot of people will say this. It's an incomplete rationale. So they say things like, well, the existing market that we are in is a declining market. Not much opportunity here. Meanwhile, there are these new markets that are growing. So we need to get out of these declining markets and get into new markets. So what's bad or what's incomplete about this rationale? It sounds more like, okay, I suck at the core market that I'm in. Well, if you suck at the core market that you're in, what makes you think that you're going to succeed in a new market? You need to come up with a good rationale for that. And there really is only one good rationale. You have to justify that doing so is going to lead to value creation. It's not just about there being opportunities out there. It's about you having the capabilities that you can fruitfully exploit in this new market. If you can make the case for that, then you have a valid rationale for a corporate level strategy. Value creation in corporate diversification, corporate level strategies typically come from what are called synergies. Other terms are also used for this. Spillover, scope economy, they all relate to actions which are taken by one unit, which can enhance value of another unit. So the term spillover, the good stuff spills over from one unit to another. Or a scope economy, which is just like a scale economy. So scale economy is if you make more, if you sell more, then your costs go down. With a scope economy, doing something with one unit enhances value of another unit. So there's potentially a cost for the first unit in making this investment, right? And there's a benefit somewhere else. But what the corporate, or when the corporate strategy is going to make sense is when the whole is greater than the parts. So synergies kind of imply that you add 2 plus 2 and you're going to get more than 4. It's going to be 5 or something like that. Of course, for this logic to hold, ultimately some value is going to have to be created at the business level, right? So you really have to, when people say, well, we're going to make this acquisition, or we're going to diversify or get into these new international markets, ultimately at the business level, somewhere, is this move going to strengthen your strategic position? Does it enable you to charge a higher price through better differentiation? Does it enable you to lower your costs and be a cost leader? Does it do something for your internal value chain? So if you're going to be a differentiator or a cost leader, you need some valuable resource there, some capability. So your economy of scope, your synergy has to enhance some capability maybe. Externally, what's this going to do for you? Is it reducing competition? Is it getting you access to new customers that you did not otherwise have and on better terms? Or is it getting you new suppliers with lower costs, or that enable you to produce better products or services? This only works if it's implemented right. On paper there might be a lot of synergies, but if it's not implemented right, it's really not going to work out. We saw some flavor of this when we were discussing the Microsoft search case. So the benefits from value creation can be offensive in the sense that strategies are pursued beneficially, where your capabilities can be leveraged in a new context to extend the competitive advantage that you have. With a defensive strategy, you're more concerned with your competitive advantage in your existing market. You're afraid that somebody is going to attack that and you want to defend against that. So you're pursuing this new strategy not because you think you're going to make money in this new venture, but because failure to attack might actually impair your competitive advantage in your existing niche. Okay, what are the sources of synergy? The best one is knowledge. It's intangible. It's something that can be used and reused, and it's really up to your creativity to come up with new applications where your unique knowledge helps you to develop new opportunities. Other sources of synergy include just functional excess resources in marketing or operations or manufacturing, and these are resources that can be redeployed to serve a new market. Ideally, your spillover resources should be things that are hard to sell on an open market. If it's easy to sell, if it's tangible, then it probably will not have as much value, or it might be easier to imitate. Also, a good resource like knowledge or information would be something that has a lot of value in multiple markets. The third thing that's important to note is you should have complementary assets. If you just have knowledge of some new patent or a technology, you might not be able to exploit it as effectively if you don't have other complementary assets that you can use to develop this product or service. Okay, so ideally you'd want to have all of these things going for you. So what does corporate office do then in a with synergies? Remember, these synergies can fall through the cracks because every unit manager is typically more concerned with their core business. They're not that concerned with, if I did this, it would create some new opportunities which this manager from this other division might be able to take advantage of, right? So a lot of synergies might fall through the cracks. So the role of corporate office in a corporate level strategy is finding ways to identify these synergies and finding ways to encourage, to monitor, to facilitate all kinds of synergies. So let's run through a list here of some of the things that corporate offices do to make sure that these spillovers, these synergies actually work out for the firm. So one way is to find a way to incentivize. Let's give credit to the investing unit because they are doing good for some other unit in the organization. So let's give them credit for the value that they've created. It might be challenging to come up with this incentive system. The other thing would be to let's supply additional funds because this investing unit is not going to make this investment otherwise. So let's give them more money and direct their managers to invest them in resources that are likely to spill over. There might be a structural solution where you centralize the assets which you think are going to generate spillovers, like a centralized R&D unit, say. So this is a unit that manages all these assets for all the business units, right? And it gets rewarded based on the combined performance. The job is to create these spillover assets. Other mechanisms would be let's find ways to facilitate transfers of knowledge. So there are some best practices that have worked at one unit. It could create a lot of value in another unit. So let's find a way to transfer this knowledge. Related to all of this is allocation of resources. Let's allocate human resources. There are smart guys in one unit. They've learned a few things. If we transfer them to a different unit, they could create value there. So allocating human resources is one. Allocating financial capital, that's another, where you direct financial capital to uses where they generate spillovers. Implementation challenges. Now you encountered a flavor of that when you did the automation consulting case. Right? So here's a company, automation consulting, pursues a corporate level strategy. It has multiple markets in which it operates. And the challenge for the company is to figure out, what kind of beliefs and boundaries and interactive control systems it should have, the diagnostic control systems it should have to execute its intended strategy. And the interactive control system, of course, helps it to figure out what the emergent strategy should be. I'm going to talk in a little more detail about implementation challenges in the international lecture to point you to some things you should especially be looking for when you do the BRL Hardy case. Okay, I'm going to leave this for the international lecture, but with corporate diversification as well. And you saw flavor of this in the automation consulting cases. How do you manage the corporate divisional relationship? You want to give the divisions a lot of autonomy so that they are entrepreneurial and creative. At the same time, you want some control over them so that they don't go haywire and do all kinds of crazy things. So finding that right balance, that's challenging. We're now going to talk about a couple of ways in which people have looked at corporate level strategy. So one is a core competencies view, and you got the picture there of a tree, and I guess the core competencies here are the roots of the tree, and the roots are supporting, in some sense, various branches. All these branches are SBUs, strategic business units in different areas. So a company, a power plant company might be making boilers and generators and turbines and switchgear equipment, transmission equipment, all kinds of different equipment, and all of these would be the SBUs, the strategic business units, and the roots would be the core competencies, which would be knowledge in application of these engineering and mechanical technologies. Other examples, Honda. So Honda's expertise would be the technology of an internal combustion engine. Right? So that's what they're good at, and all their businesses are essentially going from motorbikes to cars to boats to airplanes and lawnmowers. Essentially any kind of strategic business unit where the root, their knowledge of the internal combustion engine, can be a source of competitive advantage. Um, Corning. So Corning makes the Gorilla Glass, which goes on your iPhone. So they have a core competency in the technology, the chemical technologies that go into this. So Corning would engage in different strategic business units where it can apply these capabilities in new markets. The implication is pretty obvious. All corporate strategies have to be driven by core competency. That's the driver. You seek new opportunities where these core competencies get applied, and that shapes your corporate level strategy. So let's look at a different way of figuring out corporate strategy. This is the popular BCG, the Boston Consulting Group portfolio matrix, which says, well, if you are a conglomerate, you have all kinds of different businesses. And these conglomerates were very popular in the 60s and 70s especially. Conglomerates are unrelated diversified firms. They have a lot of businesses which need not necessarily have any kind of a core competencies. They're in all kinds of different businesses. And the role of the firm becomes more of a financial capital allocation. So the corporate office is figuring out where to put its money, and they break up the world, not the world, but their portfolio of businesses along two dimensions. So the x-axis here is a relative market share. Relative market share is intended to be some gauge of your strengths, weaknesses. So if you have high market share, it means you have high competencies. If you have low market share, you don't have very good competencies. Okay? And the y-axis is the market growth rate, which is supposed to be a proxy for opportunities. High would be you have a lot of opportunities. Low market growth, you probably have more threats. So it's kind of a neat visualization, strengths, weaknesses on the x-axis and opportunities, threats on the y-axis. And based on that, you carve this out into 4 quadrants. The first one, the cash cow, is one where you have a lot of strength, you have a high market share. The market growth rate is very low, so there isn't much growth you expect. And typically businesses in this quadrant are believed to generate a lot of cash, because you already have these capabilities. They're generating a lot of cash for you, but you don't have to invest very much. So it's free cash. They're cash cows. They give you the cash. And it's really nice because this cash now doesn't have to be reinvested in the business. It can be used instead for funding more promising opportunities. What might those be? Question marks are businesses in your portfolio where you don't have much of a market share, so you don't have much strength. You hope that if you make a lot of investment, you could move this question mark into a star. A star would be the best. The question mark, a question mark is an industry where you have low strengths, but the market growth rate is high. So there's an opportunity. If you could move to a star, you could generate. You could generate. You could be really strong in this market. It's a growing market, good opportunities, good strength. The best place to be. Okay. What do you do with your dogs? Well, the dogs are there's not much growth there. It's low market growth rate. You don't have much market share, so you divest the dogs. So what are the implications of the portfolio matrix? The idea behind the portfolio matrix is you should have a balanced portfolio where the cows provide the cash to fund the question marks that become stars. You divest the dogs. We just talked about this. And if you do that, if you have enough of a portfolio, you've hedged your bets. and you can allocate cash and make a lot of money. Um, what are the criticisms of this model? Well, one criticism which I don't even have in the list is where is the role of core competency? That doesn't talk about core competency at all. Hmm? It's there in their diagram where they say, well, if you have high market share, you have some strengths. Well, uh, that's kind of simplistic, right? To think that high market share is strength, to think that high market growth high market growth historically is a signal of high opportunities. So it's a simplistic model. And to respond to these criticisms, they've come up with more sophisticated models. General Electric has a more sophisticated model which uses more variables. And it's a slightly better model than the one we just saw. The second criticism is unlike the core competency model, it really ignores synergies across businesses. It just has to do with taking financial resources and allocating it to other businesses. Um, the third criticism is this seems to assume that uh, you need cash cow to generate cash. Well, you don't need a cash cow. You could go to a bank. You could raise money in capital markets. So this makes sense for capital constrained firms, firms that cannot access external capital markets, or firms in emerging economies where there isn't much of a, there isn't a vibrant external capital market. And so a lot of conglomerates are in these emerging economies. A lot of companies in countries like Korea, India, and so on have conglomerates, because it might make more sense here. In the US, the conglomerates have kind of gone out of fashion, right? Um, so, so what's happened between the 70s and now is that conglomerates have gone out of fashion, so the portfolio matrices have also gone out of fashion. Uh, but there is some utility to using the portfolio matrix. You shouldn't just dismiss it out of hand. It is beneficial if it is used judiciously. If it's part of a more thoughtful exercise of understanding how your businesses fit together. If you're not making investment decisions just on looking at the matrix, then it's probably useful. It's one more way of looking at the world, one more way of looking at what businesses you have, which ones are in growing industries, which ones are in industries where you have high market share. Hey, maybe this could be part of your interactive control system. I don't know. It might help you to see how these businesses fit in to their external context. But that's one of many other factors that you would want to look at in deciding how to make these investments. Okay. Evolution of corporate strategy. This is like, okay, you have a corporate level strategy, and now you're thinking about where do I go next? How is this going to evolve over time? So if you look at the first three and you think of these as three ends of a triangle, so one end of the triangle would be resources. So resources are an important driver. They are your core competencies. So one thought would be, well, I have to pay a lot of attention to my resources, and I want to figure out which ones to nurture, which ones need to be upgraded, what new resources might need to be obtained either through acquisitions or alliances. So part of what you're doing is paying close attention to your resources. The second point is, so what new businesses are these resources valuable? So you're always on the lookout for new businesses in which these resources can be applied. And the third point has to do with implementation. How do I manage my structure, my controls, the four levers of control, How do I have to change these as circumstances evolve? So as you think about, okay, I know that if I'm going to grow, I have to be developing these new resources, these new businesses, these new levers of control, right? Um, so decisions have to be made here about do we want to go for a dramatic revolutionary change, or are we going to evolve gradual incremental changes? When we create new ventures, are we going to isolate them? So if you have a disruptive technology, say, do you want to make it develop in a skunk works, which is separate from your core business, and you let them develop a new venture? Or do you integrate that very closely with what you do? Do you make big bets, bet the company, take huge risks? Or do you make smaller bets, a lot of smaller bets, and look for real options? And what's the mode of entry that you're going to pursue? Are you going to rely on just one, a combination? Which ones make most sense? So we are at the end here with, okay, so we learned a lot about diversification. Obviously, lots of firms do that. Lots of firms engage in corporate strategies, corporate level strategies all the time. But does product diversification create value? The research evidence here is mixed, but overall it's discouraging. Why is that? Why is it on average it looks like a lot of the firms either don't make above normal returns, a lot of diversified firms, or they make just about as much as the others. And a lot of the spillovers and the synergies may just be a mirage. They sound great on paper, but when you actually try to put them to work, it really doesn't create any value. Or maybe they are easily imitated. So you think you have a competitive advantage because your spillovers are rare and imperfectly imitated. Well, maybe they are easily imitated, they are easily substituted by competitors using something else. It can be very costly. We should find an opportunity to talk more about the Moneyball movie, the book, and what it implies for strategy. But clearly, if you are spending way too much in acquiring those spillover synergistic resources, you're not going to make more value. And lastly, it could just be hard to implement. So it's a sensible idea, it's worth pursuing, but you just are not able to put together the right combination of the beliefs and the boundaries and the diagnostic and interactive control system, so it doesn't work. Okay, thank you. Time to move on to the second lecture.